Welcome to this week's Q&A. We've got a good question this week from one of our viewers in the US, and he's asking a sort of, I guess, generic question in many respects. They're a couple and they've been looking to purchase a property in Australia, in Sydney actually, for over a year, and they want to use that as a rental property for now, but potentially move into that some years down the track and use that as their principal place of residence where they're going to live. So his question is, look, should I buy something now or should I continue to wait? I'm a bit concerned about a lot of the information that I'm seeing in the newspapers in relation to property price devaluations and markets potentially crashing and so forth. So great question. We all see these things in the news on an ongoing daily basis. So, you've got to look at these things, I guess, a bit more scientifically. So from a quantitative viewpoint, firstly, can you afford to buy this property comfortably? Do you have sufficient income after you take care of your expenses to enable you to service this loan comfortably? What's a rental going to be? Are you pretty sure that you want to live in that area when you go back? So a lot of those sort of more qualitative questions also come into play too, because a lot of people forget, especially Australian expats, that when they're away overseas for a period of time, and quite often it may be much longer than they first anticipate, their tastes could change. And so the place that they want to move into now may not be that perfect place to move into, say, 5 years down the track, rather than 2 when they're anticipating they may do so at this present point in time. So going through all of that's really important. But then looking at, when do you buy something, I think it's probably a reasonable thing to look at, say, what happened during the calendar year of 2022 just gone, and see what happened to prices in various asset classes. So, Australian residential property as an asset class declined by 5.3% to the end of December, according to CoreLogic's numbers. If we look at equities, perhaps, if you look at equity indices from the US, the Dow Jones or the NASDAQ might have been down anywhere from 15 to 30% over that period of time. If you look at the Australian ASX, 10% plus. So there are various, I guess, measures that need to be looked at, and I don't think that the degree of volatility that exists in Australian residential real estate is any more frightening than other assets. In fact, the opposite is true. The drawdown levels are generally far less, and the volatility is generally far less. So that's really important, because if people are going to use leverage, so they're going to borrow money from a bank to make an investment, then volatility is a crucially important thing to think about. Because if you, say, bought a property for $1 million and borrowed $800,000 from a bank, and that property goes down $20,000, most people don't have cash to inject into that loan as they would have to if they borrowed $1 million share portfolio and borrowed $800,000. That went down 20%. They would have to find potentially an extra 20% of equity to inject in that in a very short time frame to maintain their loan to value ratio and their loan covenants within that loan agreement. So really important to think that through too. It's not just how much something goes up by or down by, it's how much it moves around in the meantime, hence the volatility factor. And that's something that everyone really needs to consider and look at their own potential or their own personal financial situation to see if they could actually meet such a margin call. So lots of things that go into answering a question like that. But at the end of the day, I think 2022 has had a massive movement in most asset classes. And I should mention, obviously, fixed income, because at the beginning of last year and the year before that, I was saying to our clients that I considered that the most expensive asset class, where many countries were issuing sovereign debt at negative yields, and many companies were issuing corporate debt at negative yields, and I just didn't think that was sustainable, which again has obviously proven to be the case. So lots of things to consider in that regard. And then empirically speaking, if you're buying a quality asset in a sought after location in the Australian residential property market, I don't think that this loss aversion, this fear of loss, should play the major part of your considerations, because I think if you're going to keep that asset in the longer term, you'll find that that won't actually be something that you'll look to and say, gosh, I wish we hadn't made that transaction because it's gone down so much over the ensuing, say, 3, 4, 5, 10 years. I don't see that occurring. So really important though to look at all the other factors, as I mentioned, because it's not just about how much that asset's going to be worth in 6 months, 12 months, 2 years, 3 years, 5 years, 10 years, or forever. It's more about how you're going to deal with funding that purchase and how that's going to impact your lives in the meantime. Now, if you're in a situation like this, or you simply find this of interest, then please subscribe to our YouTube channel and click like, and I'll see you at next week's Q&A. I'm Andrew Unterweger.